听点资本，本期视频为您带来的是摩根大通在3月14日关于穿越美元关税微笑曲线的话题。首先，关税问题要成了全球经济的热点，尤其是对欧洲的威胁让人捏一把汗。铝关税也开始生效，这对贸易格局的影响不容小觑。接着，我们来看看欧洲和德国的政治动态。德国的财政一揽子计划有了新突破，绿党也点头支持，这对欧洲经济意味着什么？我们会仔细剖析。还有，日本政府养老基金投资本周出人意料地决定不调整全球投资组合比例，很多人以为这会推高日元，可事实并非如此。这个决定又会怎么搅动全球市场？最后，美联储的经济预测也得提一提，失业率和 PCE 价格指数这些关键数据会如何左右美元走势？我们会结合最新数据和专家观点，给你最前沿的解读。今天的内容干货满满，从关税到政治再到货币市场，带你看清这些热点怎么影响全球经济和我们的生活。接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Welcome to this week's At Any Rate podcast. My name is Pat Locke. I'm joined this week by James Nelligan out of London. Thanks very much, James, for joining. Important week this week for FX on a number of different fronts. Tariff saga continues. We had new threats against Europe, steel and aluminum also kicking in. We've had more progress on European and German politics with respect to the fiscal packages. And I would note as well that the Japanese pension fund, GPIF, actually chose not to adjust their global portfolio allocation ratios this week. Quite a few in the market had kind of been hanging their hat on that as an important pillar of the positive domestic Japan story for bullish yen trading. So it certainly felt like that was a notable development as well. Stepping back, though, for those who listened to us last week, you'll recall that we've kind of been describing the European developments over the last couple of weeks as something of a watershed moment. And because of that, we've revised our 1 year ahead Eurodollar forecast up to 116 from a previous high of 108. The flip side of that is that we've become obviously more dollar bearish for the first time in what I believe is several years, which reflects something of a kind of a perfect storm right now in terms of both moderating U.S. exceptionalism, both from the U.S. side itself, but also again with kind of the recent European news. That two-sided narrowing of U.S. exceptionalism has done some pretty significant damage to the dollar so far year to date, although the dollar did kind of consolidate a little bit, this week on net. And part of that eroding exceptionalism has to do with, this kind of the surprising extent, I would say, of kind of the blowback from tariff policy back onto the U.S. Certainly, you've seen that in kind of the surveys citing policy uncertainty a lot more lately. That makes sense given that the delivery has obviously been quite erratic so far. And obviously the kind of the mix of the trade partners has skewed more towards allies with, closely integrated supply chains, more so than being targeted at trade partners with kind of unfair trade practices. So the bottom line then is that, FX and the dollar reaction function looks to have shifted a little bit to tariffs this time around. And so we unpacked that a little bit this week in our weekly and introduced this kind of new conceptual framework, that I've called the dollar tariff smile. And I think most listeners on here will be, generally familiar with the traditional dollar smile in which, the dollar kind of like, is a unique currency in the FX space in which it can rally when the U.S. is doing well, but also when the U.S. is doing poorly on kind of like a recessionary, anti-cyclical left-hand side bid. We've kind of mapped that over to tariff policy and tariff delivery and find that there's actually quite a few similarities. And so, for example, I would say the expectation coming into this year based on long dollar positioning in the market, rich valuations, was that, we were going to get a significant tariff big bang delivery and one that would really kind of like amplify the existing U.S. rest of world growth gap. So again, kind of like highlighting the gap that the U.S. is particularly strong and that kind of chasm further widening out. In particular, there was also kind of this underlying sense that, the U.S. at the time was still running at a strong growth rate and would be yet further underpinned or further insulated from tariff blowback by animal spirits from kind of like deregulatory and fiscal policy. So again, kind of the right-hand side of the tariff smile was that big bang delivery, clean against all partners, in a way that would also kind of like boost dollar correlations across the G10 complex, which again would only further support, dollar strength in that. What I think we got, we've been traversing kind of down, at least after the inauguration initially, on that kind of like perceived tariff under delivery. We kind of cite that as the bottom of the tariff smile because effectively tariff under delivery is one side of a coin, the other side being that's effectively a pro-cyclical boost or a deep pricing of risk premium, negative risk premium in FX and economies elsewhere in a way that should kind of weigh on the dollar via its anti-cyclical properties. And where I think we've trended to now is that, because again, like I said up front, the erratic delivery so far, heightening uncertainty around what policy is actually going to be implemented, how long it's going to be implemented for, and really who are the primary targets here. All that elevated uncertainty has had more of a blowback effect to the U.S. Obviously, you've seen that manifest in lower yields. We've downgraded our GDP forecasts in the U.S. So it has started to skew more towards, I think, that kind of like the left-hand side, which generally should be conducive to dollar yen downside, dollar Swiss downside. But I think certainly high beta can remain challenged in an environment where weaker U.S. growth prospects are weighing on risk assets more broadly, like they have been. I think in that kind of case, you should see more of a dollar bifurcation, but still broadly supported against the likes of the high beta complex in G10 and perhaps some EM as well. So I think this new kind of tariff dollar smile is an intuitive way for thinking about like I said, the evolving kind of FX reaction function to tariff uncertainty this time around. I'll say one more thing before I pass it over to James to get his take on European developments. But I also look at CAD, and there's been some pretty, I think, interesting developments on net so far year to date in the CAD space that I will think are worth noting. For starters, it's obviously been extremely challenging kind of trading CAD on an intraday, even an intra-week basis, given all kind of the tariff headline back and forth. But if you take a step back, I think the net price action in CAD makes a lot of sense. Not only is it the underperformer in the G10 space so far year to date, it's also the only currency actually in G10 to underperform the dollar itself so far year to date. And so another way to kind of like conceptualize that is that dollar CAD has basically been flat to slightly higher recently, despite the DXY absolutely collapsing on the back of kind of the euro dollar rally. So while we had initially said that, if tariffs would ultimately be delivered on Canada, you could see a move up to 150. That hasn't happened. But again, that was kind of against an ex-ante all else equal expectation, with case the dollar, wasn't so obviously weakened. So I do think, if you overlay dollar CAD against DXY, it does, go some ways to show you the extent of risk premium that ultimately is getting baked in. In terms of what has actually been delivered, we estimate that basically there's now an average tariff rate of about 13% being applied to about $100 billion of Canadian exports to the U.S. That's about a quarter of their total exports. So if you kind of map out that total collected duty across all imports, it gives you about a 3.4 average tariff rate applied to, across Canadian imports, which is certainly material against the backdrop of the U.S. broader effective tariff rate coming into this year was only about 2.5%. And obviously with the USMCA, that was designed to actually, frankly, eliminate tariffs in a general sense. So I would call that a material ratchet. And the reality is that you started to see this really obviously manifest in some of the cyclical data. I look at kind of the latest PMIs and the forward-looking expectations for Canada. They have absolutely cratered, while DM has otherwise been relatively resilient. It frankly looks recessionary on the chart. Importantly, Canada, that indicator for Canada has never decoupled to the extent that it has against the broader DM block. So really kind of like gives you a sense of the acute pressure facing Canada specifically right now. The BOC met this week, and I would note that they did something of an off-cycle survey as well. Some interesting details in terms of, consumer expectations around the tariffs and business intentions around hiring, investment, et cetera. There were some pretty chilling numbers, I would say, in terms of hiring intentions. Upwards of 40 to 50%, for example, of businesses suggest that, if tariffs persist, they may need to cut hiring, which starts to give more of that recessionary flavor that we've been concerned about. So more broadly, I think developments recently, while obviously very fluid, just continue to kind of provide some kind of a new structural friction in U.S.-Canada trade relations that I ultimately think is negative for current cyclicals, but also negative for potential growth more structurally over time. And so with that, James, I want to get you looped in. Keen to hear kind of like your latest take on Euro developments. We've had some movement with the Greens even today in terms of support for the fiscal package. Interested to kind of hear about how you're thinking about Euro right now. Also, relatedly, how you're thinking about the European FX bloc more broadly. We had a note out from our economists earlier this week, taking up UK and Scandinavian growth on the back of the German and the broader European recent movements there. So interested to see if you have kind of like a similar application to the FX bloc. And then finally, be curious any kind of tactical thoughts ahead of the central bank meetings next couple of weeks.
Sure. Thanks, Patrick. Yeah. So obviously a lot going on, as you say, and as you say, we've got to have the news today around the what looks like some final agreement between CDU, CSU, SPD, and the Greens in terms of reaching some kind of initial agreement on the fiscal spending package in Germany. We've been trying to track how this is moving through the Bundestag and the potential stumbling blocks. But we are looking, forward towards the vote on Tuesday next week for some further clarity there. But you've got to kind of overlay that with the other things that are going on in European space. As you say, obviously, we saw the retaliation on metals tariffs from the EU this week as well. We saw President Trump come back on that with threats of pretty significantly larger tariffs on the European champagne and alcohol space. And so, the market is kind of, debating those kind of trade-offs. And you look at euro dollar here above 109. It's overshot fair value slightly if we use kind of real rate spreads and periphery spreads as a kind of guide. And before today, there was a little bit of consolidation in euro. The market was questioning, some of the progress that was being made on these themes. But for us, really, ultimately, you can debate the numbers in terms of the German fiscal package and the impact on growth. But I think the bigger picture here is what we're looking at is just an investor landscape whose portfolio allocations are really not calibrated to the kind of signaling value of a eurozone that's willing to engage in fiscal policy. That's been missing for decades, and along with that, foreign allocations to European assets have been missing for decades. That's the bigger picture here, and we think those kind of allocations have room to adjust and take the euro complex higher. Now, the risks to that are obviously around tariffs, but as you alluded to, Patrick, I think the market has had a shift in terms of the way it's been wargaming these kind of scenarios. So if Trump were to go ahead and implement 25% tariffs on Eurozone that he's flagged before, including potentially things like VAT, the market is asking itself, what else is he doing in that world? Probably a lot is the answer. And that speaks to, as you say, Patrick, the blowback of tariffs on the US itself. And that's a real shift in the way the market thinks about the reaction function of a pair like euro dollar to tariff headlines. So even though, yes, Eurozone tariffs are going to have less blowback on the US than Canada-Mexico tariffs, because there's a lot less exposure there in terms of the exposure that the US has on the trade side, the market is still asking itself that question, because obviously Trump has dragged his feet with Canada and Mexico for several months now, going back and forth with threats, implementing, not implementing. So you have to ask yourself, well, if he actually implements the tariffs on the Eurozone, what else is he doing in that world? And the answer is probably quite a lot. And that shifts the reaction function. As you were saying, Patrick, it takes us onto a different part of the dollar smile. And so we're looking at, our view on the market here is that the market's going to look to buy the dip in euro dollar on these kind of tariff headlines. And then, as you say, Patrick, for the dollar side of euro dollar, I think it's going to be really key to see how the US survey data comes in for March. So you could even argue, and I would argue, that some of these kind of regional growth surveys that we're going to get next week for March could even be more important than the likes of payrolls and CPI for assets, especially equities, because that's going to tell you whether the companies still have the same concerns that they had in February, and how severe they may be in terms of the impact that government policy is having on sentiment. So you have a lot to work with there, I think, and we're very much keeping to the bullish euro dollar bias. In terms of the spillover of that to the rest of European currencies, you can see that a lot of European crosses are behaving pretty much as a function of euro dollar. So if you take Swiss, for example, you've seen euro Swiss higher while dollar Swiss moves lower. If you take sterling, you've seen euro sterling higher while cable moves higher as well. Again, both of those very, very much a function of euro dollar. And we wouldn't be surprised to see that continue, because the themes that you're seeing on both the Eurozone and US side are just have a lot, have potentially quite a bit further to run in our view. And then I think for the Scandies, it's a bit more direct in terms of we expect both the European and US themes to favour Scandi currencies stronger against euro and dollar. But just getting into the central bank meetings, so Bank of England, we think they're going to be unchanged next week. It's pretty consensus. There's basically nothing priced. Guidance unchanged as well. We are looking for a 7-2 vote with 50 basis point easing votes from Dinger and Mann, similarly to how we saw in February. And more broadly, kind of the weakness in UK data, as everyone's seen, has kind of stabilized over recent weeks. Activity data surprises are actually close to range highs. And as you say, Patrick, our European economists, including UK and Scandies, have actually upgraded growth slightly to account for the beta to Europe. So all that, all else equal, that kind of growth shift, supports sterling, but we'd say there are still downside risks here from, I'd say, the relative fiscal stance as we move towards the OBR forecast update at the end of March. So we got monthly GDP out of the UK today. That showed a drag from manufacturing. That's pulling the OBR further away from its 2% forecast. We could well see some fiscal tightening at the end of March, at the same time as we're looking at that German fiscal bill, which definitely points you towards euro sterling upside in our view. And that's a pair that we're actually surprised to see is still trading cheap to fair value, only marginally cheap, but still we would expect definitely some kind of overshoot there, I think, if those two fiscal outcomes really do come to fruition. You also have potential for UK labour market weakness. That's something we're still waiting on, really, in the hard data. So we've upgraded our euro sterling forecast profile just to account for those risks, as well as the more bullish euro forecast profile that we put in last week. The S&B is, in our view, it's a bit of a closer call than what the market's looking at. So you've got about 17, 18 basis points priced. Consensus in terms of the forecasters is uniformly for a cut. There's only a few forecasters in there, but we'd argue it's a bit closer than that. I think, there's probably less of an urgency for the S&B to kind of use its what would be its one of its last bits of ammo in a world where core has been quite sticky, headline inflation slightly above forecast. So it's a bit closer, we think, but there's obviously bigger themes we'd say going on elsewhere that we've talked about on this podcast, and so on a kind of hold decision where they don't cut, then I think the market will be quite quick to buy the dip in euro Swiss, given what's going on elsewhere. For the Riksbank, probably less eventful. Pretty much widely expected to be on hold. Rate cut pretty much off the table because you've had some hawkish CPI and GDP data. the rate path we think, or economist thinks, is going to be pretty much unchanged versus December. So it's just setting out that flat forecast profile of 225 on the policy rate, which is pretty much what's priced as well in the market. So not much to see there. And I think for Stocky, you've got some tentative signs of kind of dividend season creeping into the price action. We had said that was going to kick in around the 19th of March, which is what historical analysis would suggest. But it wouldn't be too surprising to see it start a little bit earlier than that. But you do have, I think, broader, bigger themes, more medium term that we've spoken about again, with this idea of US equity repatriation into the economies and the currencies that bought the most US equities over recent years. And that would include very much Stocky, that we think is still a durable medium term theme. But, Stocky has moved a fair amount. I think it's up there as one of the best performing G10 currencies so far this year. But what hasn't moved is NOK. And we've been saying that that's really the laggard in terms of what could potentially move next on some of these European and US themes that hasn't moved, where valuations are cheap. And if you see European growth stabilize and turn higher, and then you see some US moderation start to leak further into US yields, and that feeds a kind of carry to value rotation, NOK should very much benefit from that. And what's held it back so far has been the oil and gas moves and the anticipation of Norges Bank easing. We'd rather use that as an opportunity to really latch onto a more bullish view on NOK going forward.
Thanks, James. And maybe just to wrap up, obviously, generally we front load Fed previews in most of our podcasts, but obviously, like a lot of other stuff, I think is kind of stealing the thunder right now. We're still waiting to hear from our chief U.S. economist on his specific outlook, but it doesn't feel to me like at this juncture that it's going to be a meeting that obviously dislocates the dollar or gives it some kind of new trending direction. I mean, you think about what Powell said at his latest appearance last week. He actually seemed relatively sanguine, I think, in the scheme of things, against obviously risk market stress that reflects to some degree some rethink around cyclical prospects here tactically in the U.S. So no signs of alarm coming from him there. He did, however, though, kind of continue to reaffirm the Fed's dovish asymmetric bias. So I do still think that holds. I always think of that in terms of, the dual mandate and kind of the SEP projections. Specifically what the unemployment rate forecasts are in core PCE. And so in that respect, next week will definitely matter for getting the updated SEP forecast for them. But, against what they've already penciled in, yes, we had a move higher in the unemployment rate last week that was above consensus, for it's now up to like a mid 4.1s. But that's still below kind of the median unemployment rate dot for the Fed as of their December forecast, which is at 4.3. So it doesn't seem like at this point they're obviously offsides or need to obviously, change their tone substantially and kind of how the labor market is evolving. And similarly, I think our core PCE right now is tracking 2.7 over a year ago. The central tendency for their 2025 forecast is 2.5 to 2.7. So altogether, it doesn't seem like the Fed is necessarily entirely offsides. And of course, it's in a backdrop of extremely high uncertainty. So it stands to reason, I think, that probably not going to see a ton of fresh information that's really going to drive the dollar significantly one way or the other on beyond the single session on Wednesday. So to your point about other data, stepping up in terms of relative importance lately, I fully subscribe to that, and we'll continue to keep watching U.S. activity developments and European activity developments. I think we'll leave it there. Thanks very much for joining. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025 JP Morgan Chase & Company, all rights reserved. This episode was recorded on March 14th, 2025.